Good morning. Welcome to the Daily Huddle on a Money Monday. We've got some interesting things to talk about this morning. I'm so excited to be back with you guys after missing last week. But we're recharged and ready to go. So my name is Zack Otey. This is my wife, Kimberly, and we're your co-hosts for today. And I know there's a lot of questions going on out there, so we'll get to that in just a few minutes. But before we get started, I wondered, Sorrel, do you know what the football coach said when he went to the bank?
No, Zack, I don't know.
He said, "I want my quarterback." All right. Well, there's a lot of crazy stuff going on right now, and there's a lot of concern out there, and the news is telling you one thing, and you're asking questions. Maybe you are, maybe you aren't. Hopefully today we can kind of answer some of those questions for you as we go through our Money Monday on what should I know about FDIC insurance. But before we get started on that, let's go through a few things just to get us in the right place and the right mindset today. So how about this? Rashida, can you unmute? Can you answer one of our questions for us today?
Of course she can.
Good morning. Good morning.
Good morning.
Good morning. Good morning.
So what time is it, and what are you grateful for today?
The time is now. Right now. There's no other time but now. Even that they spring forward me, it's now. And I'm grateful. I'm grateful to be here with my family, with my daily Huddle family. And with that, I'm hot, but I'm still here.
We are thankful you're here with us as well. And yes, everyone sprung forward, so you can see it in our eyes, right?
It's amazing what a difference an hour makes. So, well, Sorrel, where are you, and who will you hug today?
I am right here, and I'm going to hug Shade. You know, I've been avoiding my dog for like a week.
That's awesome.
I'm going to hug him.
I think he needs a big old hug.
Big old hug.
Like a squeeze, yeah, for sure. For sure.
Yeah, I know ours do. So we just got home after a week of dog sitting. So they definitely need some help. So, well, Chase, good morning. How are you today?
Grand day. I am exactly the way I say I am. And today I am powerful beyond measure.
Happy Monday.
Outstanding.
That's awesome.
Outstanding. Well, guys, we're so glad to be here with all of you today. For those of you watching on online or streaming platform, welcome also. But I'll tell you, we're going to just kind of dive in and share some facts, and then we'll open up to some questions. We're by no means banking experts, and things change all the time. But I know that that we've gotten a lot of questions from our existing clients, and just also in passing on the way home from our trip, because of the news that's going on about the Silicon Valley Bank collapse and those kind of things. And people want to know why this happens and what this means for them. And then there's a lot of really kind of exciting, in a bad way, getting us excited headlines out there from all kinds of media sources. And people just want to know that things are okay, and are they okay? So the short answer to that is that for most people, everything's fine. That's the short answer. The FDIC insurance limit, which protects depositors, went up back after the last collapse from $100,000 per depositor to $250,000 per depositor. So in short, if you don't have more than $250,000 in a single account at a bank, you're okay. So for most people in America, that's the short answer for that. As far as economic stability and what that means, we'll talk about that a little bit as we go. I do know that that the federal government, multiple different branches, including the executive branch and the FDIC, and also Secretary Janet Yellen, who's in charge of the Fed, all got together and said, based on the way the laws changed back in 2010 with what's called the Dodd-Frank Act, that these types of things are built into protection, where that the people at the bank in Silicon Valley, even over and above that limit, will be protected, and that it will be assessed to the banks, not the taxpayers. So those are other questions that people have, is if we just make up all this money to protect these incredibly wealthy people, where's it coming from? Are we all paying for it? And so the short answer that I've gotten to this point is no, we're not paying for it. And they want to keep the banking system stable so we don't have another 2008. But Kimberly's going to talk to you and share some slides with you guys about what the FDIC does and how it works. And so you can have an intelligent conversation about that if somebody asks those questions. So
before we do that, why don't you talk about what actually happened? Because if it weren't financial, I might not know. I don't watch the news because it's usually negative, right? So unless it's a big deal, I don't really know. So tell us what actually happened with Silicon Valley Bank, and then also I think Signature Bank maybe yesterday or the day before. Tell us what happened with those banks and explain that to us first, and then we'll talk about FDIC insurance.
Well, the short answer from me is I still don't know. I think a lot of people are trying to figure out exactly how you go from several $1 billion in positive assets to being basically in a bankruptcy receivership type scenario overnight. And so what happened there, I believe, had a lot to do with the type of funding that bank provided. They were a very, very large provider for startup businesses in Silicon Valley, which can be a highly risky sector to fund. And that was their need. That was their niche, or niche, as my kids would tell me. I should say it differently. So that put them at a very risky proposition, which had not been risky as of the last several years, but the NASDAQ and the markets of the tech sector have not been performing well. And there have been lots fewer IPOs, so lots less money coming back to the bank from the actual sale of these startup companies. And I would imagine that, again, that this started from some collapse or failure of some of those companies and the inability of them to make their payments to the bank.
I think also probably rising interest rates, right? And I know in the mortgage world, we went from 2.5 to almost 7 in the span of a year, and that's significant. So I would bet that the raise in all of those borrowing rates of the banks being so significantly higher than they had originally been hurt some of that as well.
Yeah, I mean, and when you think about that, if you have a home equity line of credit or something like that, that's a variable rate, you've probably seen that change considerably, which can also change your monthly payment, which in these cases would make it very difficult for these institutions to continue to make a payment if their interest rate doubles or triples. So yes, I think your rising interest rates have definitely played a role in that for sure.
So let's talk about what is FDIC insurance. We've already talked a little bit about that. And what do I need to know? I think it will be very interesting to see how this plays out and see how long this plays out and the trickle effect that it has. Some of the articles that I was reading, and we were with some friends in Boston this past weekend, and they are in the tech sector, and payroll processing significantly affected as well. So just it will be interesting to see all of the shifts and domino effect, if you will. But until then, let's talk about actual FDIC insurance, what you should know, and what you should do if you need to protect yourself against that. So FDIC insurance, what should you know about FDIC insurance? We've already talked a lot about that already. Quite simply, the Federal Deposit Insurance Corporation insures up to $250,000 per depositor per institution and per ownership category at member banks. So all of those pieces are really important to understand. But what can you do if you have more than $250,000 in the bank? What does that look like? How do you protect yourself? So step one is open an account at a different bank. If I have $260,000 at Truist, then maybe I want to pull some over to Bank of America, right? And just have two different bank accounts at two different banks to protect my money. Because as long as I only have 250,000 in that one bank, I'm good. I can add a joint owner. So Zach and I, if I have a bank account and I have $260,000 in it, and I'm at risk, right? Because it's not insured over that $250,000 amount, I can add Zach to my account because he's obviously my husband. We can have a joint owner. I can give him all the money. Just kidding. I'm just kidding. But then it's going to double our protection. So we would have 500,000 instead of 250,000 as far as FDIC insurance. The third thing that you can do is get an account that's in a different ownership category. So what does that mean? And I just copied a lot of these down here. FDIC insurance coverage applies to several ownership categories. So single accounts owned by one person, which we just talked about. Joint accounts owned by more than one person gives me more protection. Certain retirement accounts, including IRAs, revocable trusts, irrevocable trusts, corporation partnership and unincorporated association accounts, employee benefit plans, and also government accounts. So if your money is in one organization, but it's in different account ownership statuses, and it is more than $250,000, you're covered because you're in different ownership categories. Anything you want to say to that?
No, I mean, it's important, but we talk about business ownership and entrepreneurship a lot, and it's really important to understand that hopefully if your business is incredibly successful, right? I know sometimes I feel silly talking about $250,000 in a checking account because I know for most people that's not their concern, but there is a concern about how this affects everyone. And so we thought it would be interesting to talk about and kind of pertinent at the moment to just kind of say this is what this means. So when you hear it, you kind of know what's going on. But sometimes you will talk to folks with a trust, or you will talk to people that have, and they're very concerned. We spoke with a client yesterday that was very stressed out about what happens, if this affects my bank, what do I need to do, and how can I do that? And so that's all, just to let you know that the little bit behind the scenes of how this works.
Yep. Education makes you powerful, right? Because you at least understand what your options are and what your choices are. Step number 4, option number 4, you can join a credit union. So similar to the FDIC, the National Credit Union Share Insurance Fund insures up to $250,000 per person, per institution, per ownership category at credit unions that have National Credit Union Administration memberships. So if you're part of a credit union, just make sure that your credit union is through this organization, and you should be fine. Use intra-fi network deposits. And a lot of this, so you can see at the bottom, this came from a NerdWallet article, because I was like, I don't know, what can you do? What are all of your different options? And I thought, if I didn't know, y'all probably didn't know either. So some of these last ones are interesting because I had no idea. So you can use the intra-fi network deposits, formerly CDARS, I assume, and ICS. The intra-fi networks deposit program, previously known as the Certificate of Deposit Registry Service and Insured Cash Sweep, allows you to get FDIC insurance on millions of dollars through a network of financial institutions without having to open accounts at multiple banks. Instead, you can keep all of your money in one bank, and as long as that bank is part of the intra-fi network, the program will funnel your money into deposits accounts of your choice at other network banks. So basically, you have one account at this bank, but they're going to farm it out to different banks, right, to make sure that you have that coverage and that FDIC protection on all of your money. So I thought it was really interesting. Option number 6, you can open a cash management account. A lot of non-bank financial service providers tend to offer CMAs, and some of those have debit cards and check writing agreements and things like that. But the FDIC insures the cash balance of a CMA, with some institutions offering coverage for up to $1.25 million to $2.46 million total. And they're able to do this as members of that same intra-fund network deposits program that we just talked about before. So I thought that was interesting that you could protect that much money just using a different type of an account. You also have the option to put your money in a MaxSafe account. A MaxSafe account maximizes FDIC insurance coverage by offering protection for balances of $250,000 up to $3.7 million total per person. Wintrust is the company that offers MaxSafe accounts, provides the level of protection by distributing deposits across more than a dozen community bank charters, similar to the intra-fund network. And then finally, opt for an account with both FDIC and DIF insurance. The Depositors Insurance Fund, or DIF, is a private insurance fund that insures depositor amounts at member banks beyond what the FDIC covers without a limit. And I think that particular one, it said the only banks that allowed that are in Massachusetts. So I thought that was really interesting. But those are ways that, you know, if you have a significant amount of cash or a significant amount of money in the bank and you're concerned about it, those are all different ways that you can protect it, that you can restructure it, that you can move it and make sure that you're okay. I know for most of the world, it's not even an issue, but I do think it's important for all of us to understand, how does it work? What does it look like? I know through the years we do, obviously you guys know, we do financial services and financial planning, and through that comes a lot of managed money accounts, but also a lot of insurance products like annuities and things like that. And in the past, we've had that question about annuities, you know, are these FDIC insured? And the answer is no, they're not FDIC insured, but insurance companies have never collapsed like the banks, right? So you got to manage your risks. They're insured by insurance companies. Banks are insured by insurance companies. So we have a common denominator here. But I just think it's all interesting. I think it's super fascinating. I think watching what happens in the markets and watching what happens over the next few days will be very, very interesting. So
Yeah, I think it's funny that you said that about insurance companies, because that's one of the things I was going to kind of bring up as well, is that there are other options other than bank depositories for your money as well. And there are reasons for that there, because I think an informed consumer understands, and that's what we do, is we teach financial concepts and we allow our clients or our customers, if you will, to choose what best fits them based on the knowledge that they've gained through our process. And one of the questions we have gotten a lot is this that you're recommending an FDIC insured product? And I really think that that's kind of a sales pitch almost that the banks have attached to lower risk, if you will, when you've seen volatility twice in the last, 15, 20 years, major volatility in the banking sector, but in the insurance world, their solvency requirements are so much different. I think that's one of the things that changed in 2010 with Dodd-Frank, was that banks were required to maintain more cash reserves than they were prior to that. Well, insurance companies' cash reserves required are still considerably more than what banks are. So that's why you don't see that out there very often. That could happen. There's no guarantee and there's no insurance against it if it does happen.
but insurance companies have reinsurance companies.
It's
basically
FDIC is an insurance company, the Federal Deposit Insurance Corporation. So banks, like Kimberly said, are backed by or covered by insurance companies, and the insurance companies have kept our government in a good spot many years since the end of World War II and the end of the Great Depression all the way back. So insurance is a good spot for investments, for cash, for those kind of things, if it's used properly. And so that's what I was going to add to the end of that too. So we were kind of on the same wavelength there. So
there you go.
I know we're right here at Q&A time, so I'd love to answer questions if you've got them.
And if we can't answer them because we don't know, let's just talk about it. Like, what do you think is going to happen right now? I think it's an interesting time and a fascinating moment that we'll all learn from, whether it affects us directly or it doesn't. So let's open it up for chatter. You want to chat?
I'm happy to. So, yeah, Stan, go ahead.
Hi, thank you so much for that great information. Let me ask you something, realistically speaking. It's hardly ever going to happen. I doubt it. But would a bank really be able to, or would the Federal Deposit Insurance Corporation really be able to honor those payouts if enough individuals, if a large number of individuals actually had to call on that?
Yeah, and so what you're talking about is basically a run on the bank, which is
a run on the bank.
Yeah, which is
The banks.
ultimately what happened to Silicon Valley Bank, is that there
Mhm.
were enough people that were scared about what was going on and what they had seen, that they went literally in person and tried to withdraw
Pull their
cash,
money out.
withdraw capital. So, but could they? So this is what happens is they slow the process down. We had the same conversation with a customer yesterday, or client yesterday, where they said, should I go tomorrow to Chase and get my money out? And if I say I want it all right now, can they give it to me? And the short answer is you shouldn't go tomorrow and ask for it all to come out, because they're not going to have it in cash. And it's not something that that they just keep on hand, right? But our system is built in such a way that, yes, they can honor it, and they can, it is because of the insurance and the way it's built, it will be able to be honored. But like the assets that were in Silicon Valley Bank will be honored in the next 14, 21 days, right? So the money's not gone. They just have to see where the assets are, and they have to move them all around, and then they have to, and actually I think I just said this earlier, but they just guaranteed deposits in Silicon Valley Bank over and above that as well. And there's something built in Dodd-Frank that assesses the banking community to make that right, to make that good, not the taxpayer. So banks have an insane amount of profit. You know, when we go in and deposit, if I deposit $10,000 into a certificate of deposit, they're going to pay me probably more now than they have in the last couple of decades, but it's very small. But then I go to borrow that same $10,000 to buy a car, and they're going to loan me that money at a 7 or 8% interest rate. That's all profit for the banks, right? So they have that money in there. That's how that system is built. So they're very profitable institutions. And if they're the ones carrying the heavy risk or the heavy burden from their financial coffers and not us as taxpayers, that's makes me happy, right?
But I do think your question poses an interesting question, because none of us really know, right? If we literally had a run on all of the banks right now, would it be possible? I mean, like normal brains say no, of course not, right? I mean, absolutely not. But I don't know.
I think about the scene
don't
from
know.
Mary Poppins years ago, where the little boy was wanted his money back, and everybody in line at the bank started freaking out because his dad worked at the bank, and he was mad because he couldn't get his toppins or whatever back out of the bank, and everybody in line just started to, of course, in chorus and singing, wanting their money back at the same time. So, but Gio, you have got your hand up. Great question, Stan. I hope we helped a little bit there.
Yes, thank you, Stan. Yeah, one of the things that I felt was interesting, really interesting to notice, to see, is how the best minds in the world, the best economist minds in the world, didn't see that raising the interest rate too fast was going to impact the cash flow and the balance, the economic balance of all the banks, given that there's so much that they're investing on bonds, on treasury bonds, and at some point, well, when the interest rate was low, they were paying really low, and now that the interest rates are high, well, everybody's taking their money out and putting them in high interest yield bonds. And so it's not only the New York Bank or the Silicon Valley Bank, but all banks are dealing with the cash flow issue incredibly, because those people who can take their money out when the contracts are up, and now they can put it somewhere else
To make
well,
money.
transfer that money. I mean, why would? And it's, I was reading the article and I thought, my goodness, this is almost self-explanatory. How did an economist don't see that and say, no, we can't raise the interest rate that fast? So I find it fascinating. I'm not worried about the U.S. economy at all. We just keep, I'm not at all. But I found it fascinating that we created this royal mess on something that obviously in hindsight looks obvious, right? But it's sort of like interesting. It's interesting.
Yeah, it's fascinating. It's kind of like the housing collapse, right? Everything was great until all of a sudden it wasn't, right? And it I don't know, it's fascinating. I think you have a lot of unintended consequences, right? Whether it's banking and FDIC insurance, or, you know, decisions you make with your kids or whatever, you got to really think through all of your different options and all of your different choices, because there is always going to be a domino effect of something, and some of it you can't foresee. But when it seems so obvious, you're right. You should be like, could you not see this?
Yeah, unintended consequences. That's a fascinating term. It's not what you meant to happen, but it's what happens. And I think what we saw that when all the money was being printed, which was necessary to help us get through it to a certain extent, to get through the COVID crisis, as individual families and households benefited from that. But at the same time, when you create money out of thin air, you will have inflation. So the unintended consequence of that is we have to then combat inflation, which is traditionally by raising interest rates. But when you have inflation greater than we've seen it in our lifetime, and you try to combat it with raising interest rates that quickly, like Gio said, there's going to be some unintended consequence, right? All this being done in that
And
balance.
I really feel like lending had really just opened up, right? And there were credit card offers everywhere, and there were mortgages everywhere, and like money was flowing back to people in loans and notes, you know, because interest rates were so great and banks had so much and so plenty. So yeah.
And unfortunately, to that note, we're in worse credit card debt as a nation than we were in 2008. And so that's where it's again another unintended consequence, or maybe intended. You know, I've been giving talks for years about how the banks are not built for us, they're built against us, and that we need to understand the rule of 72 and basic financial concepts about how our money doubles either for us or for them based on what we're paying or earning in that. So Stan, you got another hand up. What you got?
Yeah, Gio made a statement. He said he's not worried about the American economy at all. And I think the thing about it is, in my opinion, when I think about that statement, I don't think we're worried about it as much as we should be. And I think that and maybe we're not worried about it at all. But when you think about how the economists and everything miss something like that, like, here we are, we're looking at that. All it takes is constantly missing stuff like that. But it'll really be problems like we have that can really create that domino effect and just really, and we're printing money that has no real value, because we're printing more than we have assets. Now they want to use the debt sometimes. They want the money that we have to collect and the economy, working people offsets the debt. But I'm wondering how true that really, really is now. And I tell you the truth about it, I think our economy is in worse shape than we really, really, really thought.
All right, Gio.
Yeah, I want to say something about that, and I completely agree with Stan. Where I am coming from is that when I look at the U.S. economy and when I look at the journey of my own economy, right? So the U.S. economy has gone through World War I, World War II, Vietnam War, Korean War, Gulf War, COVID. There is something about the entrepreneur mind of the context in which the United States lives that it gives really good evidence that people are going to reinvent themselves in the progress way. Now, my own economy, I've been homeless, toothless, like my economy is my thinking. It's not the U.S. economy, it's not the world economy, it's not the COVID economy, it's like, what am I going to do today to provide value to the marketplace, regardless of what's going on in the economy? And never mind what's going on in the economy, people build their own economy, and in different countries and different economies. So the reason why I say I'm not worried about the U.S. economy at all is because I know my economy, what impacts my life is not the U.S. economy, it's my economy and my ability to innovate, reinvent myself. And as long as I got that clear for myself, I'm going to be fine. And the people, I'm completely fine. I mean, we got to, get to work and provide value to the marketplace, and the marketplace will give us back that return. Now, of course, there's this crazy stuff that happens, and it will impact me like it did COVID at the beginning. But the aspect of personal responsibility for one's economy will leave anyone free from anything that happens in the world.
Yeah.
Yeah, that's where
And
I was coming from, Stan, but I don't disagree with you at all.
But
No,
I
that's
love that
perfect. That's
response.
perfect, Gio. And you're right. That's perfect.
Yeah, I love that response. And it goes all the way back to your money mindset, right? And how do you think about money? How do you think about the world? And this is a perfect time, even if you have to work on it, not to fall into that scarcity mindset, right? Not to collapse. During moments like this, there's so much opportunity to explode, and you'll see it. You'll see changes. You'll see people exploding. So that's what I would challenge you to do as we wrap up for today, is look for those windows of opportunity, because they are there. They are being created every single moment, and in all of those, moments of uncertainty and nervousness and scarcity, there's also opportunity. So look for that. And I agree with you, Gio. Your personal economy will be amazing forever. So
Yeah. Thank you for that. I could not wrap it up any better than that about our mindset and how it should come
That
out
was
of
beautiful.
today. Is that
That was beautiful.
crazy stuff going on, but Gio's exactly right. What happens in your personal economy is the only thing you can control. So let's focus on the things we can control, and let's control the heck out of them. So,
well, thank you guys for joining
Wow.
us today. It's been
Thank
an
you, Kimberly.
amazing,
Thank you, Zack.
enlightening
Thank you, family.
FDIC insurance. Thank you, banks, for giving us something really fun to talk about.
right.
But we will wrap it up. You got to do it, because I can't do it.
All right, guys. Well, as we close out today, remember to love wherever you go. Laugh out loud. Stress less. Ooh, boy, I didn't want to bring stress on. We want to stress less. Thank you, Gio, for that. Eat mostly plant-based. Take care of yourself. Give. Sleep. Move. And then check yourself before you wreck yourself, right? Make sure that you don't go out and stress out other people or bring more on yourself. So, all right, guys, thanks again for a great morning, and we will see you same time, same place tomorrow.
Bye, guys.